Good evening, everyone, and a warm welcome to the webinar. My name is Neeraj Kotian, and I'll be the moderator for today's webinar. I'm part of customer interaction team at Quantum Mutual Fund. First, let me thank you all for taking out time on Friday evening and joining us for this session. We'll request everyone to use their headphones for better audio clarity. Session will have approx 30 to 45 minutes of presentation, and then it will be followed by Q&A. You all can post your questions in the chat box once the presentation is over. So as you all know, the topic for today's session is navigating the path to success with small cap funds. Given the inflows in small cap funds I've seen over last year, one should be mindful of the risk and challenges posed by the investments in small cap funds. Hence, today our fund managers will share the insights on how to overcome this and identify a true to label small cap fund that focuses on portfolio liquidity, chasing growth opportunities, while being mindful of valuations, governance, management quality, adequate diversification, and not over-diversification. So before I hand over the control to our speakers, let me introduce them to you all. Our first speaker for today's evening is our CIO, Mr. Chirag Mehta, who has more than 19 years of experience in the financial market. He specialized in the field of alternative investment strategies. Chirag is qualified CAII, Chartered Alternative Investment Analyst, and has also completed his Master's in Management Studies in Finance. He currently manages a 4 fund, largely in the field of alternative investments that includes gold fund, a multi-asset fund of fund, and equity fund of funds. Chirag was named amongst the top 40 fund manager globally under the age of 40 by Citywire UK in 2017. Our second speaker is Ms. Abhilasha Satale, an associate fund manager who has over 18 years of experience in Indian capital market as an analyst and senior research manager on sell side and buy side. Abhilasha joined Quantum AMC in June 2022. In addition to being an asset fund manager, Abhilasha is Quantum's primary analyst for oil and gas, consumer durables. She has also tracked different sectors like capital goods, infrastructure, chemical textiles, etc. in the past. She has handled portfolio management of H&I clients on the buy-side research and catered different institutional clients on sell-side research. Abhilasha received her MBA from Valuations Institute of Technology in 2003. So, without taking much time of yours, I will ask our CIO, Mr. Chirag Mehta, to take her at this session.
Sure. Thank you, Neeraj, and thank you everyone for joining us today. I think, Quantum does not launch funds often, as you would know by now. Last NFO that we had was in 2019 of the ESG equity fund, and all those investors who invested in it probably have a good experience with that fund because it's not only true to label, but also given good returns to investors. So I think you have seen a good interest from investors in the small cap space. I think many of you all would have invested in small cap funds elsewhere. But, the riding has been good. We have seen good returns from small cap funds. But, are we overlooking some of the risk in those funds? And therefore, what kind of fund you should be invested into is what we're going to talk about in this webinar. So let me take you through a few slides and let's see, what are the challenges that we see in the small cap space and how or what is the best way to navigate those places. So overall, if you see, why small caps, right? Small caps account for 85% of all listed companies. So if you see from a SEBI classification perspective, the top 100 stocks are large cap stocks. Then another 150 stocks after that is mid-cap stocks. And anything after that, after the 250 first stock onwards, is the small cap fund. So given that it is a very large universe, which translates to a large opportunity set overall for you as investors. So it also gives us as fund managers an opportunity to buy into, various companies to choose from a large gamut of companies that operate in that small cap space. And even if you look at meaningful companies in that space, there are plenty. If you see from 400 crores to 21,000 crores, where the small cap world starts, there are more than 1,300 companies in that space. Also, if you see, the large cap universe is become very, very skewed. If you see from the top three sectors, which is finance, IT, and oil and gas, it occupies 65% in the large cap space. And even if you include the fourth sector, which is FMCG, it is almost totaling to about 75% of the total allocation in the large cap world. So very, very skewed allocation in this large cap space. But if you look at small cap, it is skewed to some sectors, but not as skewed as what we see in the large cap space. For example, finance, which is 40% of the large cap Sensex index, it is only 14% of the small cap index. So, relatively much less skewed. Plus, at the same time, it gives you an opportunity to be in sectors which are not there in the large cap space. For example, you have various new budding sectors, which even the government is trying to push in a very big way. For example, agriculture, tourism, transport services. It is believed that, we have the one of the largest logistics cost when it comes to our relative logistics cost in the country. Logistics cost is nothing but movement of goods from one place to the other and the warehousing of those goods. So overall, we scale up or we are much higher or relatively higher as compared to many of the emerging economies and even as compared to the global economies. So if things were to, domestically move in India and consumption increases, which will need that movement of goods and storage of goods, then probably the transportation costs have to come down over a period of time. So that is one sector that you get an exposure to, which is not there in the large cap. So overall, there are many, many sectors which are new budding themes available in the small cap space, but not in the large cap space. And what themes that we are talking about? Everyone talks about the jam trinity that we have seen in the economy, right? Jandan, Aadhaar, and mobile, creating that financial penetration, even to not restricting it to metro cities, but spreading out into tier 2, tier 3, B30 cities overall. So we have seen that financial inclusion spread out, but within the financial inclusion, it's not only that banking is the only sector. You have many other teams, like small finance banks are doing well when it comes to micro lending overall. There is MF distribution, there is broking as a theme, which are available in the small cap space, but generally not available in large cap space. Another, what we see in auto as a sector, auto, we are positive on that sector. And there is a transition happening from ICE engines to electric vehicles. So when that happens, as an OEM, you're trying to attract new customers who could move to the EV bandwagon and overall, adopt EVs in a bigger way. So everyone is trying to get that customer, of which we are very little today because the cost of ownership of EV is high. And therefore, Maruti, Mahindra, or any other car maker will be able to attract only a set of clients. Whereas if you're an auto ancillary company and you're part of that EV ecosystem, then probably you can cater to all of these customers at the same time and also have an export opportunity, because globally also we are seeing that trend of moving towards EVs. So that leads to, a big opportunity for an auto ancillary company, much larger than what you will see for an auto car maker. Similarly, there are various different themes like import substitution, like government is trying to reduce our imports of electronic goods and therefore giving a lot of incentives to PLI and other schemes to ensure that, these companies can grow and we have a larger electronic manufacturing in India. China plus one is a bigger theme going on where, global manufacturers are looking for an alternative to China because they are not very certain of the policy making in China, which leads them to, move to different destinations or look out for different destinations, which are stable, which have a good policy making. And that is where they can set up a base alternative to China. So in the pharma space, we are seeing that a good scope where active pharma ingredients is one space, CDMO, etc. Then there are specialty chemicals because China has been a big seller of specialty chemicals. India is emerging as a new alternative to China when it comes to specialty chemicals. From an environmental theme perspective, climate change is real, and renewable energy companies kind of who make biofuels or be it solar, wind, etc., could do well. It's not only restricted to energy production, which is cleaner, greener, but also there are various themes that are in the environment like water waste treatment, recycling, water consumption, etc. That you can make it efficient. There is a theme that's going on in that space called zero liquid discharge. Many companies are helping other industries to ensure that they have zero liquid discharge and therefore There is not much waste, liquid waste going into rivers, lakes, etc., which over a period of time will be a penalty, attract a high penalty for these companies. So overall, there are many emerging themes sectors that you get exposure to in the small cap space, which are budding today, but show a big promise in terms of the growth pathway that they can have. So overall, they are very scalable business models. They have proof of concept, etc., and therefore they could be, a part of your portfolio through a small cap fund. Also, people confuse small cap with startups in a big way because startups are very, very risky. They still don't have a successful or scalable business model. They have an idea, they are innovative, they are trying to, build a space or niche for themselves versus a small business in a small cap fund kind of, which could be there in the small cap fund, has a big potential for success because they have a successful proven business model. They have cash flows, they are making revenues, they are making profits, and they are showing that they can scale significantly over a period of time. So don't confuse startups with small businesses, because startups are indeed very, very risky. When a PEVC investor gets into a startup, they kind of assign a probability of, say, about 20-25% for any company that they buy would succeed. But in small businesses, it could be very, very high, 60, 70, 80% could be the ratio of success for a small business. Also, there are many opportunities in the small cap. When you look at a small cap company, there are reasons for that because they are very, very under researched. They are unexplored with companies. If you look at the large brokers in the country, all of them cover large caps, but only 25% of them only cover small caps. So there are about 32 large brokers in the country. Out of 32 of them cover large caps, only 8 cover small caps. Also, they are very, very under-owned, like ownership by institutions is lesser in these companies. There is room for PE re-rating. So when you're looking at a stock, right, there are 2 levers of returns that can come in any stock. One is there could be earnings growth. So earnings growth will lead to higher returns over a period of time. And at the same time, there could be a scope for PE re-rating. So when a business is unexplored and it's showing potential for growth, and say it is trading at 10 times PE, investor can come saying this business looks good. This is a sustainable business model. The company has been generating good return ratios. Company is looking that it can scale further. And therefore, I am willing, because large caps may be trading at, say, 20 times. So investor can come and say that, it's trading at 10 times. I think, this should trade at 15 times, given the return ratio or return profile that it showcases. And therefore, that leads to a higher PE re-rating in that stock, which could deliver additional return for you as an investor. So there is one earnings growth story. These companies are growing very, very fast. That could lead to meaningful returns. And at the same time, there could be scope for a PE re-rating to add more returns to your exposure. Also, these are very, very innovative businesses. They have created a niche for themselves, a segment for themselves. And, given that they are first mover, and therefore, given they are innovative and created a niche, they kind of have built a moat around it. And therefore, they are not easy to disrupt, and therefore, they can scale up very well in the future. But with opportunities, remember there are risks. And what are the risks that we are talking about today? Is that these small companies may find it difficult to attract the right talent, to attract capital that they need for growth. And therefore, that could pose as a challenge to what we see a very rosy scenario. This could be a challenge that company face. So you need to be cognizant of that fact when you invest in these small cap companies. So they may have a big order book, but if they do not have ability to execute, the right people to execute, then probably they may not scale up as well as what you thought or what the opportunity is for them today. Also, you need to remember these companies, small companies, are have lesser history of promoters. We don't know how promoters will behave over different cycles or different economic situations, and therefore, given that, there has to be these are lesser governance companies. So overall governance is questionable at times because we haven't seen enough of these managements. So you need to be aware of the corporate governance profiles. You need to be very thorough. Who is clean, who is not clean, and only invest in companies where we are sure of corporate governance. So given that all this backdrop, you may be invested in a small cap fund, but you may be happy with the returns that they've generated over the last 1 2 years, but there could be a risk. So it is for you to assess that risk and identify whether are you willing to take that risk, or you need to move out of that fund which is looking risky and into a fund that promises that it will adhere to certain thresholds and therefore not take that risk. Please understand that in a small cap fund, you're already taking a higher risk that will commensurate with a higher return, but you don't want to take unnecessary risk of liquidity and other things that could come along with a small cap exposure. So overall, we see that there is an increasing footprint of small caps. Overall, it's a very growing space. If you look at a period of 2008-9, the small cap world starts at a 251 stock as per the current definition. So 250 for stock, whatever it was in 2008-9, was to around 2,500, 3,000 crores. The same stock today, or not the same stock, but the 250 per stock, whichever it is, because it keeps changing, whichever is a 250 per stock, today that stock is about 21,000 crores. So overall, the market cap of these companies have been growing. And if you look at the table on the right, companies with more than 1,000 crore market cap are also more than 900 companies out there. So this is a growing space overall. And, market caps of these companies have been growing over a period of time. This is very, very important for you to focus, right? And see whether, the funds that you have invested with, do they have this kind of problem or not? And if yes, you should be cautioned and you need to take a decision on whether you want to stay in that fund or move to a better fund. So today there are 24 funds in the small cap space. If you divide the total AUM of the small cap funds by 24, the average AUM is about 8,000 crores. And average number of stocks in the portfolios are 80. So if you see number of stocks, the column below that, we have seen funds with about 55 stocks to about 196 stocks in their portfolio. So it's all across the spectrum, right? And it is a very, very heavy portfolio, most of them, in terms of the number of stock holdings. And if you look at the right-hand side of the table, the second last column of the bigger table, number of stocks with less than 1% weight have been significantly high, 50, 60, even 90%. So number of stocks with less than 1% weight are suboptimal weights. So with so many stocks with lesser weight, many of these funds, given the size has grown over a period of time, are behaving like a closet index. And if they are behaving like an index, then probably, why should you as an investor pay an active management fee for something that is having a characteristics like an index? So there was a good article a couple of days back in one of the leading newspapers where, where there was a table that showed that how the number of stocks of each small cap fund have increased over a period of time, over last 1 year. So the number of stocks over last 1 year have anywhere increased from 10% to 30%. So supposedly if the fund had, say, 100 stocks, they have become 110 to 130 stocks over the last just 1 year. And many of these funds had much better portfolios a few years back. They had 40, 50, 60 kind of stocks in the portfolio. But as the size has grown, they have been forced to increase the number of stocks in the portfolio. So, you need to be, you need to say that whether, is it a good fund for you or is it not a good fund for you? So what you thought was an older track record with 50, 60 stocks, now with 90, 100 stocks, the characteristics of those funds have changed. And therefore, what you thought that you were buying as an apple is now a banana. So you need to make sure that the fund you're invested into, they have not changed that characteristics. And if they have changed, are you okay with that change in characteristics or not? And if whether the performance that they had in the past, is it repeatable given that they have increased the long tail portfolio with very, very suboptimal weights in the portfolio? Also, you need to look at in terms of liquidity, which is very, very important. In a rising market, things may look liquid, but when the flow stop, the performance stops, that is the time when, liquidity really comes into question, because what was saleable earlier may not remain saleable anymore. So from that perspective, you need to be very sure of the liquidity profiles of these funds that you've invested with. And we saw a few funds, and within the few funds, we just took the top 10 as a proxy, because top 10 are high conviction bets and the fund manager very sure about it. And we said, let's see how much liquidity do they have in the top 10. And we gave 66 trading days for them to see whether they are liquid or not. And 66 trading days is globally acknowledged a good time frame in terms of a fund manager entering or exiting a position completely. So we said, let's look at 66 trading days, which is equivalent to 3 months time frame. And if you see, most of the funds in the top 10 even had 60 to 70% of the portfolio, which will take more than 66 days to liquidate. So it is very, very illiquid in that sense. If you look at the fund D in the table, you will say that liquidity is better in that fund. It's only 24% is illiquid in the top 10. But if you look at the column on the right, of the top 10, 46% is large and mid. And large and mid are more liquid. And therefore, either funds have compromised with the liquidity of the fund, or they have compromised with the mandate. You had given a mandate to invest in small cap companies, but here they have deviated and moved into more large and mid. And if you see, even within the top 10, which is the least liquid position of the portfolio. So some funds have, 150, 200 days it will take for them to liquidate the least liquid position, even in the top 10. So overall, there are funds which will take about 1600 days even to liquidate their position. So are you okay with this kind of liquidity? Because, something is illiquid, they try to sell and the price may collapse. So what you think was, a profit on the paper may not remain that profit, because when you put those redemptions, the fund managers goes and sell those stocks, and whatever the end of the NAV, which is after the price that they have got for selling, becomes the NAV that you receive. So what you saw on paper may remain on paper, and you may not realize those profits in actual, because the prices of the stocks fall when they try to go and sell those stocks. Also, what we've seen is one peculiar trait that you should be aware of, and which is kind of a big risk, because they have suboptimal positions, like we spoke earlier, long tail portfolios and the smaller weight portfolios. So there are many funds which own some companies, and the company weight in their portfolio is very, very small, 0.5, 0.6%, but they are 7 to 8% of the ownership of the company. They are 7 to 8% owners of the company in form of shareholding. And look at the liquidity of these stocks. It takes anywhere between 160, 200, 1600, 400 days to liquidate those positions. So imagine a situation where, a large owner of the company, 7, 8% holding, tries to sell the stock, right? And it is already illiquid. What will happen to the stock price when they try to sell this large ownership in that company? So there's a high probability that the stock price may fall because of they are selling, because they are already large owners. And though they are a small portion of their portfolio, but they are large owners in those companies, which are already liquid, and therefore, there could be repercussions on the portfolio that you're holding. So overall, we think that in the small cap fund, liquidity and market cap are very, very important. So you need to invest in funds that are very, very liquid. They have a liquidity threshold. Otherwise, what you see on paper may not realize in actual. That NAVs that are there may not be transactable in a true sense, because what you see, you may not receive it. It's not a transactable thing, because they're selling because of your redemption can lead to the price fall, and therefore lesser returns for you as an investor. So overall, in our small cap fund, we have predefined limits on liquidity and market cap, and which defines the fund capacity. And whenever we reach that capacity, we will close the fund for new subscriptions. And given the universe in the small cap fund space is so large, you need a very strong research capability. And Quantum as a firm is known for identifying good research ideas and build a portfolio out of it. We have a very large research team, and we are known for doing a bottom-up research, and therefore that capability will be helpful to build our portfolio in the small cap world. Third is there is an emphasis on governance and management quality. We think this is non-negotiable, given that there are promoters who are new, who are we don't know how they will behave in different time frames. So you need to evaluate them very, very closely. And given that our experience, we have an integrity screen at the group level since 1996, and even in our mutual funds, we have used that integrity filter since 2006 in all of our equity investments. And given that, we think that we can sift off managements which are good, which are bad. And therefore, that integrity, that screening that we have on governance or management quality is going to be very, very useful when we try to buy stocks and evaluate stocks in the small cap world. Our approach here, though we are known as value investors overall, but in the small cap space, these are very, very fast growing companies. And therefore, you need to ensure that there is growth for these businesses who can grow really fast. But at the same time, you should be aware what valuation you are paying. So we will buy them at fair valuations, but we'll ensure that they are growing companies. So growth at a reasonable price is the approach that we have in small caps, I think, and this is best suited for creation of a portfolio from a small cap perspective. And we will be long-term buyers of these stocks and ensure that they kind of compound over a period of time. Also, if you see in the small cap world, as I said, that liquidity and market cap are very, very important. So we have predefined threshold levels in our offer document that we will not buy any stock which trades less than 2 crores per day on an average for last 12 months. Like in the value fund and ESG fund, we have the criteria of not buying stocks which trade that less than $1 million a day, which is about 8 crores per day. But in the small cap world, we realize that there is so much volumes present in that segment. Therefore, 2 crores is a good threshold to have, and for the universe at least. And market cap will be between 400 to 21,000 crores. But any point in time, we will ensure that the market cap we are not more than 5% of the market cap of those companies. And liquidity is something that we will ensure that minimum is 2 crores, but any point in time, these stocks should be liquidable in 66 trading days in 3 months' time. So I think these are very, very important traits or most defining traits in the small cap world. And say and these criteria on liquidity and market cap define the capacity that you can run the fund to. And we think that, beyond a certain size, it does not make sense from a risk perspective. Otherwise, we'll be taking too much liquidity risk for you as investors to be part of. And therefore, we don't want to take that risk. And therefore, whenever we reach a size we think is optimal from a liquidity and market cap perspective, we will surely come across and close the fund for new subscriptions. So imagine a situation where trying to build a 5,000 crore fund, for example. This is just an example out there. And minimum weight that I want to assign to any stock is say 2%, which is a meaningful weight to have, not 0.5%, 0.6%, or less than 1%. So we want to have meaningful weights. So minimum at weight we'll buy it is 2%. And if I am buying 2% of 5,000 crores, I am investing 100 crores in that company. And if I am investing 100 crores, and if I want to enter or exit that position in 66 trading days, I need a minimum volume of 1.5 crores. If I want a minimum volume of 1.5 crores and assuming that I will not be more than a third of the market, then I need a volume of 4.6 crores per day on an average for me to easily liquidate or enter a stock without having an impact on the prices. Also, from a market cap perspective, if I don't want to be more than 5% of the market cap of the company, then I want a minimum market cap at a 5,000 crore size, at least to be 2,000 crores. So all this framework of liquidity and market cap helps us to define the capacity that we have and to give investors what we call as a transactable NAV. So that, what you see on paper as profits remain as profits even in the real world. And therefore, we will be mindful of the capacity of the small cap fund. And I'll reiterate that we will close the fund when we reach that size. So with that, I will hand it over, invite my colleague Abhilasha, who's going to be the co-fund manager in this fund along with me to run you through our approach into small caps.
Yeah, hello attendees. Good evening. Thank you, Chirag. So Chirag has taken you through, how the world, small cap world is, most of the different funds, how they are positioned. I'm going to brief you about how is Quantum's approach to address these issues, how is our research process robust, and how are we going to construct our portfolio. So as mentioned initially, we will be very much mindful of the liquidity constraints what we have. That is one of the most important criteria for us, because we want to protect the capital also when the market falls. So this is one thing which will tide us over through the liquidity volatility what usually small cap companies face. While doing so, we will have very disciplined buy and sell limits. So we have a very large research team and we cover different sectors. We have a very in-depth knowledge about those sectors, and through whatever the research process we will have very disciplined buy and sell limits. We will not just chase the momentum of any stock. We'll go through very disciplined approach towards our research process. And as Quantum's philosophy is, we will go invest only for the long-term perspective. We will not invest into something very short-term or momentum stocks. So that's the Quantum's approach towards overall investing. And for small caps, we have a growth parameter. So whenever, if the company is growing for a longer period of time and we see that it has a more to grow over the medium term, we will go and invest into the companies at reasonable valuation. So this is our overall research approach to small caps. Yeah, so this is like, as we mentioned, that overall addressable universe for small caps is around 945 stocks for us, which fall in a market cap of around 400 crores to 21,800 crores. And amongst these out of these universe, we will screen stocks based on their past record in terms of quality of management, capital allocation by different managements, what are the financial parameters, and we will screen these stocks to around 450 stocks based on their historical performance and the industries what they operate into. After screening those stocks to 450 stocks, then we will do some in-depth research on the sectors and the businesses what they operate into, the stocks which are having some kind of moat for their operations, cash flow conversion of the companies, and we will screen it out to around 250 stocks. And here we will make sure that all of our analysts meet most of the companies, do 5-year projections. We do a lot of research meeting, lot of brainstorming sessions to see how the company's performance will be over a period of time and at what price it is we are getting that overall projected earnings at the current level. And accordingly, each and every recommendation will be viewed within 180 days. And after that, we will form a portfolio of around 25 to 60 stocks. So most of the portfolio approach will be on a bottom-up basis. So if we feel that any of the sector is very overvalued and we are not finding good ideas in the sector, then we will avoid the most where we are getting good bottom-up ideas and we get management confidence, there we will go and invest our money. So this is like overall investment approach we will have towards our portfolio. And this is a portfolio construction process. So if the stock is under our coverage, then we will see whether it is a part of small cap index or not. That doesn't matter. So we'll see how much upside it offers from the current level. So if the upside is reasonable and it is likely to give us around 15-20% CAGR over a medium term, then we will try to buy this stock. So it doesn't matter which sector it belongs to, and that is how, like, the considerations for us will be more like reliability of management, how the earnings are coming for the company, whether those earnings are stable, whether cash flow conversion is positive from those earnings, how is capital allocation of the future earnings. So these are most of the things which we will look while selecting the stocks, and that is how we will create a portfolio of 25 to 60 stocks with minimum weight of 2% at cost and maximum weight of 4% at cost. And at any given point of time, we will not exceed 10% of the market value of that stock. Yeah, so this is one question which everyone would have at this time in the mind, that whether small caps, small caps rally we have seen in the past after COVID, they have run up quite a lot. So whether small caps are overvalued, is it a right time to invest into small caps? But anything is related to the valuation. So basically, what happens whenever stock price goes up, it has to be backed by the earnings growth. If it is not backed by the earnings growth, then we can see the stock is overvalued and we cannot invest into that stock. So as far as small cap rally, whatever we have seen, largely it is backed by the earnings growth. So I will not say this to the every stock which has run up, but most of the stocks, at least, as we are covering many of the stocks, and we are meeting managements, most of the managements of the companies, we are getting that confidence that managements are still seeing the growth continuing in earnings, and the rally is backed by the strong earnings it has posted in this universe. So if we see, this is quite evident from the fact that if we see the median average of the valuation of small caps versus the Sensex, or small cap versus their own historical valuation, it trades slightly below the average. So this could also be because of the exuberance we have seen in the 16, 17, 18 period. But even if we remove that kind of exuberance, small caps are at average or little bit above average of their historical valuations. So, as I said, the universe in small caps is quite large. It is around 1,000 stocks. And if we want to select good 25-60 stocks within the universe, then it is quite possible at current prices. There will always be mispriced opportunities in small caps. There would be few stocks which are still not covered, and there are good management which are working really hard to grow their businesses. And we would vouch to hunt for those kind of businesses and managements and invest into that. So these are our fund features. Our investment objective is the investment objective of the scheme is to generate capital appreciation by investing into small cap stocks. The benchmark is S&P 250 small cap TRI. It's an open-ended scheme which is predominantly investing into small cap plans, direct and regular plans. Both the options are available, and whether it is in lump sum or SIP, these options are also available. So basically, the overall objective of the scheme is to generate returns for the investor by investing into small cap stocks. So as it is mentioned, I'll be co-leading this fund with Mr. Chirag Mehta. So Chirag Mehta is our CIO and fund manager. He has managed funds in quantum, like fund of funds, multi-asset fund, ESG fund, gold, and now small cap fund also he will be leading. And he has joined Quantum in 2006. And as I hold more than 16 years of experience in Indian capital markets, and I have worked as buy and sell side analyst, and I have covered different sectors. And so that is how we will, lead the team. So these are like different funds which Quantum has, and we have given the risk return profile of the Quantum fund. So if you see that the debt funds and fund of funds, they are lower risk and lower return kind of fund, whereas Quantum Value, ESG, they fall somewhere in the higher strata of that chart, whereas small cap will be the highest, which is always considered as a higher risk and higher return kind of fund. So this is like overall the chart which shows that what is the risk return profile for the small cap fund. So, as you know, like where small cap will find its place in Quantum's overall strategy or overall offerings. So, as we have been saying that 12 months of expenses will always be like into the liquid fund. Gold fund ideally should form around 20% of your savings. And 80% of the savings should be like equities, wherein the long-term value fund will have a higher chunk, then ESG, and then small cap fund, because as we have always been mentioning that small caps are a high risk, high return kind of portfolio, high return kind of fund, and therefore the volatility in this fund is likely to be higher than what we have seen in our value and ESG fund. So accordingly, small cap can fit in that strategy. Depending on your risk parameters, risk and return parameters, you can allocate money to the small cap. And the small triangle, what you are seeing at the top, that is actually for any trading or anything like Bitcoin or any sort of the very volatile asset base if you want to invest into. So that's like that is why we have kept that small triangle. But this is like overall the portfolio will look like. Then yeah, the next. So this is, many of the times also we get the questions like, as we are raising money, then how will we deploy it? So this is our track record for deploying money of Quantum long-term equity fund, value fund. So we launched our fund in 2006, and at that time also the market was at high level, but so therefore we collected the money, but we deployed money very judiciously over a period of time in most of the corrections which came after that. And for small cap also, we will have the similar kind of approach. So we will just not chase, the momentum and invest at very high levels and all in very highly valued stocks. We will have very mindful allocation towards our whatever money we are collecting through small cap, and we'll invest very judiciously over a period of time, seeing the corrections which are coming in the market. So, and this is what our performance of long-term value fund as over a period of time, we have seen it has given much better returns as compared to Sensex, its benchmark. So this is what we strive for small cap also. So this is so I'll just end the session here. Thank you all for attending, and I'll hand it over to Neeraj for any further questions if you have. Thank you.
Thank you, Chirag and Abhilasha, for the insightful presentation. We'll request all our listeners to post their questions in the chat box. Chirag, there's one first question to you. There are a few excellent small cap funds with a long-term track record. Why would I switch from them to Quantum? What's unique about Quantum?
So if you're happy with your allocation, but if you see risks that we've highlighted in those funds, because we've seen that risk emerge in many of those funds, given that illiquidity, large ownership, suboptimal positions, long tail portfolios, etc., which we think are not good from a risk return profile, and probably it may change the risk return profile that you've seen of your portfolio earlier versus what they may deliver now. So there is a higher probability of that happening. And from our perspective, we will ensure that these over and above risks that you take with a small cap fund you do not get exposed to. For example, we will be mindful of liquidity. We'll be mindful of ownership in terms of not exceeding 5% of the market cap of the company. And above all, our robust research process and our eye for governance. I think that's going to be a differentiating factor overall when we build the portfolio. So I think our judicious approach and not taking additional risk, because with small cap, please understand you're taking slightly higher risk, right? As opposed to the normal equity market investing, or as opposed to normal large cap investing. You are taking that risk because these companies have lesser history, corporate governance is not evolved. So all those things come along with small cap as a package. So apart from that, we don't want investors to take additional risks like liquidity, ownership, suboptimal positioning, because understand the fact that there is diversification is better, but over diversification starts hurting return. And with a long tail portfolio, like 100 stocks, 150 stocks, 200 stocks, you are, in our belief, are over diversifying. So we may be wrong, but we think that we've done various studies on diversification, and to some extent we think this is over diversification. Take an example: if you have a 0.5% weight in any stock, even if that stock doubles, you're just adding 0.5% return to the overall return of your portfolio. So that means that many stocks have to do well at the same time for you to earn a better return. And when you talk about doubling the stock or doubling the return, then probably how many stocks in the portfolio will you be able to achieve such super normal performance, right? So overall, that leads to an over diversification, which in what we believe could hurt performance going forward. And therefore, we will build a diversified but not overly diversified optimal allocation with a weight of minimum 2% and 4%, so that we deliver a good risk return profile to investors.
Thanks, Chirag. Chirag, next question is we have been always made to believe that small caps are most volatile class and were advised even by QMF to keep away for so many years. But suddenly, why QMF also changing its stance to pitch small cap now? Is it for EM?
Yeah. Now, of course, we do still believe. That is why we have already cautioned that it is a volatile space. So you need to be wary of your allocation. But we still think that 10 to 15% allocation is still deserved to this category. And the reasons being certain changes that have happened in the landscape. Because if you see with the new SEBI classifications, the large cap is top 100, mid cap is 150 after that. So these two universes have become very, very constricted in nature. And therefore, there is a large opportunity set that exists in the small cap space. Even funds with meaningful market caps of 4,000 crores and above, for example, this we showcased in our slide, right? So if you look at number of stocks with even 4,000 crores or 3,000 crores and above, is still about more than 550 stocks. Above 1,000 crores and above, which is still a meaningful size, is about 900 plus stocks. So the universe has grown, which is giving us a very large opportunity set, which was not the case earlier. The new rules have come very, very recently or in the last couple of years, which have led to that definition defining and constricting the universe of large and mid cap funds. So we think that with what we're seeing as a large universe in a large opportunity set, we see that there is a room for us to value add and build and deliver a better portfolio to investors through our research, through our eye for corporate governance, and not taking those overt risks that we see existing in many funds today. So without those risks, we want to deliver a sensible return while ensuring that we kind of try and minimize the volatility risk as well. See, when it comes to risk, volatility is not the only risk. It's just a moment of up and down. But really losing your capital, we believe, is the biggest risk. And with poor governance, not good research, and having a long tail portfolio, probably, it does not serve investors well. So from that perspective, we can deliver a better risk return profile, take advantage of the large universe that exists there. And we are not saying that it's not volatile, going to be volatile. It's going to be high volatile. So investors should be knowing that before they invest. But at the same time, I think there is the scope for us to value add. And that is why this fund now.
Thanks, Chirag. Abhilasha, next question to you. You have already covered in your slide, but small cap stocks are very high valuations. How can you earn profits from this high valued stocks?
Okay, so I think we covered a slide on that because so on a valuation, it is a very relative term when we say valuation, because we are seeing valuation in terms of the earnings. So if earnings are continuing, if you see on a forward basis, so some of the small cap companies are still growing at much faster rate. As I mentioned, there are many good managements out there. They're really working very hard to increase their to increase their growth in the respective industry. They have already created some kind of mode. They have built a customer base for themselves, and actually they are not as impacted as the large cap companies because of the macro what is standing out, what is happening in globe or what is happening in India at a very macro level. Small caps are not that much impacted. They are very, very niche business models. So we have to see every company differently when we are analyzing small cap universe, and valuation is a very broad based very broad based term. So if we take some of the small caps, yes, of course they are overvalued. We are also finding challenges in that terms, how when we see even on a forward basis, some of the companies are overvalued. But when we are making our portfolio, we will be very much mindful of the valuations. We will only invest into those businesses where we are finding the managements are really working hard and they have created those kind of niche for their businesses and will continue to grow over a longer period of time, and still are not as overvalued as other small cap, some of the small cap names. So we will do that process very judiciously, very honestly, and accordingly we will allocate the money. So and as I mentioned, for our universe, we are only building a portfolio of around 25 to 60 stocks. So out of that 1,000 stocks of universe, if we have to find, say, 25, 60 good management, good cash flow generating, good growth companies, then it is possible even in the current market situation. If I have to build a portfolio of, say, 150 stocks, 200 stocks, then that's a big challenge, because then I will end up buying just a momentum stocks or those stocks which have already run up and are trading at high valuation. But for us, if we work honestly towards our process, then valuation should not be a major constraint.
Thanks, Abhilasha. Chirag, next question to you. What are your decision criteria to exit a stock? What is your approach on cash calls given the overvaluation that happens in small cap once in a few years? Do you envisage taking exposure to micro cap stocks as well in the schemes, those moved to main board from SME board, etc.?
Yeah, so overall, the exit is very, very clear to us. We will have a disciplined buy and sell. So we are very clear if the stock, know how fabulous the company may be, if it does not deliver an upside to us over the next couple of years, we will not be invested into those stocks. Probably they may correct and we may rebuy those stocks if they are available at a valuation that we prefer and offering certain upside that we want to get. Barring that, we will sell those stocks. So one is that criteria. Second is governance. If you find anything on governance from that company, then probably we'll sell out of that. It's unlikely, but because we will have done our homework in terms of identifying the governance issues in those companies. But anything that comes to light on governance, that's non-negotiable. We will exit out of that. So these are predominantly, one is it hitting our sell price and not giving more upside from there. Because whenever the stock reaches our sell price, we immediately review that stock and to see if we are not missing anything. If we are not missing anything, there is no scope to upgrade our numbers and it still looks like a no upside stock, then we will sell out of that. So that's a very clear criteria on a discipline in terms of buying and selling that we'll have. Second is on microcap stocks. See, microcap, there is no regulatory definition of microcap today. Some define it from 500 stock onwards is all microcap. Some define it below 500 crores of market cap is microcap. So there is no standard deviation. Everyone is emerging with their own definitions today to what suits them as a microcap story. So we are very, very clear that, we will have a meaningful market cap, at least above 500,000 crores and above. So if the definition says that it is below 500 crores, then probably they will not be part of our universe. If it is, above, so anything 500,000 crores and above will generally make it to our portfolio. And generally, we will see that 2,000 crores and above is the market cap that we will prefer to buy it in the portfolio. So because we don't want to be more than 5% of the market cap of any company. So until that thing satisfies, which is unlikely the case in the microcap world, probably will not buy into microcaps. So probably our universe will be 1,000 to 21,000 crore segment that satisfies the small cap criteria and also enables us to buy something which is not more than 5% of the market cap of the company. So those are the criteria that we'll go with, and therefore, we will not be looking at that. And there was a question, I think I forgot to address that earlier in your question, that, are we after AUM No, we are not, right? If we were after AUM, we will not launch something that is, could reach the capacity very, very soon, right? So because it's small cap, we have these guardrails of liquidity and market cap. Probably, it may not make sense if we are really after the AUM. Probably we'll launch a flexi cap fund, we'll launch a multi cap fund, which will have much larger sizes. We'll launch a large cap fund, which will have much larger sizes. Here we think we can add value, and that is why we are launching the fund and not because of the AUM.
Abhilasha, next question to you. Would you apply any technical factors like beta, etc., in shortlisting stocks given the volatility profile of small cap universe?
No, actually, we don't use technicals in any of our analysis. So that's not our method is very fundamental based. So as I said, that we have used screeners. We have used some of the screeners while screening the stock, but those are purely on the financial parameters of the company, their past history, their past capital allocation, ROE, ROC. So overall, most of the parameters what we have used, those are largely for the financial. We usually avoid any exposure to leverage companies. So as far as in small caps, yeah, there are technicals work for some of the companies, and we know that some funds they make those kind of investment. But as far as quantum is concerned, we are purely fundamental driven. We have never used any technical parameters for our buy and sell criteria, and we will not use for that. Wherever we find that the stock can give us good upside potential at 15-20% CAGR over a period of time and will grow at that rate, we will go and buy that stock where we have a management comfort. So that is like our overall processes. We will stick to it. We will not go for any technical parameters.
Thanks, Anish. Chirag, there is a question on Quantum Long-Term Equity Value Fund. Can you just throw some highlights on the performance of the Quantum Long-Term Equity Value Fund?
Yeah, of course. See, in the Quantum Long-Term Value Fund, people, looking at 5-year, 7-year performance may not see a very good performance in that time frame. And that was owing to 2 years that we saw. 2017 was a year when markets were frothy, not supported by earnings growth. And therefore, we kind of underperformed that period because we didn't find value in that time frame. Because everything was going on hope. We saw a 34% rally in markets in that year, 2017. And given that when we spoke to companies, there was nothing happening on the ground. It was just a PE expansion story. I can show you that chart even, to get our point across that it was a frothy market. It was not supported by earnings. So if you see this chart, from 2014 till 2017, there's hardly any earnings growth that we saw. Each year, analysts started with a very high assumption that, next year we will see earnings growth, given that we had a single party government. The government will do reforms and bring the economy on the path of growth. But that never happened in that time frame. And that was nothing moving on the ground. So that hope never translated into earnings growth for the economy or for the companies. And therefore, we saw that it was a frothy market. Markets kept moving up and it was a PE expansion story rather than really the earnings growth story. So in 2019, again, was a period where there were a lot of tax changes that happened in the economy for many companies out there. And, many of those were not part of the portfolio. Given that, we have certain unique traits that we see from a value perspective to buy into. And many of the value stocks didn't see the changes in the tax profile, whereas other stocks did see. And therefore, it hurt our performance on a relative basis. And therefore, we did not do in both the years, 2017 and 2019. But if you see the recovery post-COVID, because, post-COVID, people were a bit nervous, were pricing in things on a conservative basis. At the same time, things were really moving on in the economy. The economy was seeing a lot of traction. There was a growth for revenues, growth in earnings of companies. And therefore, markets, though kept rising post that period, were very well supported by earnings growth. And we did get participation in terms of performance in that period. And you see the performance post-COVID, last 3-year performance looks much, much better. So overall, we think that, given the where interest rates lie today, there will be scope for value to continue to do well over the next couple of years. And we see a lot of our companies that we own have good traction in form of earnings growth. So probably we will recoup the underperformance that we have over 5-7 year periods, and we'll do well and recover much of it. So overall, we think performance has picked up post-COVID, and it will continue for next 2-3 years at least.
Thanks, Chirag. Chirag, question on small cap. Like, what is the period of exit load applies? Is it 1 year or longer? And what is the exit load? There is a continuation of the question. Like, is STP allowed to move, or STP or switch allowed to move from liquid funds to small cap funds, or lump sum also can be switched?
Sure. Yes, the exit load will be 1% until 1 year, and post 1 year there will be no exit load. And given that STP, yes, STP is allowed, switch is allowed, but it has to hit the fund. I mean, the small cap fund, exit out of liquid and hit the small cap fund by the closure of the NFO. So if that happens, yes, that could go ahead. Neeraj, I think I was correct in that response.
Yeah,
right?
yeah, right.
So overall, yes, switch you can do from liquid fund into this fund, but provided you time your switch such that it should come in the small cap fund, it should go out of the liquid fund and come into the small cap fund before the closure of the NFO.
So next question is, you as a fund house are very judicious in your offerings. Why at this point in time you have decided to do a small cap fund? What's the eureka moment for you here?
As I said, the universe has become very, very large for small caps, right? And the other two universes have become very, very constricted. And given this large universe, we can identify through our research some very good ideas that we can build the portfolio with. And our eye for governance really helps us to stand apart from the crowd out there. So overall, we think that given this and our discipline on certain trades of minimizing other risk from a small cap investing is what we can bring to the table and build a portfolio. We see the challenges in the industry. We can address those challenges. And I think our discipline helps us address it very, very well. And as you know by history, we are very, very disciplined when it comes to these trades. And we have been, it's not now. Value Fund had the liquidity criteria right since 2006. ESG Fund, when it started in 2019, it had the liquidity criteria right from day one. So we are known, and you would have heard us from many, many times that, a fund, a mandate has a capacity, and there has to be adherence to that capacity. And that capacity is determined by the liquidity of the portfolio that exists. And therefore, we think we can deliver a meaningful portfolio, something that adds value to investors. And, we can do it here in this space, given the large universe, take the advantage and deliver a sensible return and minimize the risk that comes with the small cap investing.
Thanks, Chirag. Abhilasha, next question to you. Currently, how many small cap names are in your coverage universe? Because that would define how deep the team can do a research.
Yeah, so in our value team, we also cover some of the small caps names. So there are already a few small cap names which we are covering, and we will increase the coverage there. Apart from that, we also have, we have also been building our portfolio, and we have backtested that portfolio for a longer period of time, and that has outperformed most of the times whenever, at whatever time periods we have tested that. So we have very judicious, before launching, we have done our homework in terms of how we want to construct our portfolio, how the research process will be. And we, as you know, Quantum has a very very large research team. We have more than 20-25 analysts covering different sectors, and every analyst would be having some small cap names in their portfolio. So already we have a good coverage of the small cap names. It is just that as they are not forming a part of value portfolio, maybe you are not aware that we are already covering those kind of stocks currently under our research. And as we launch the fund, we will further increase our coverage in the space, and already like we are meeting many management. So this is just the whatever you are seeing, it is just you are seeing just me and Chirag, but there is a large team which works at the back end to support us and give us many ideas, meet different managements, run do projections on the companies for a longer period of time, set buy and sell limits. So that's a very big process which we follow. As we are following for the value fund, we have already established that kind of process for the small cap fund, and that will help us in carving out those few names which we are vouching for constructing the portfolio, small cap portfolio. So this is
if I can chip in, I think the whoever asked the question is looking for a number in terms of number of stocks that we have covered. So in total, in different timelines, we have covered about 170 to 180 names in the small cap space alone. So we have been doing our homework, and as you would know, Quantum will only launch a fund when it thinks that it is capable from a research perspective to support that portfolio. And therefore, we think that we are able to deliver a portfolio which is research backed completely, and therefore we can buy. So if you ask me in today's parlance that if I have to build a portfolio of 150, 200 stocks, yes, it is difficult for me because that's where my coverage stands today. But out of that coverage, if I have to build a portfolio of 30, 40, 50 stocks, yes, we can do it even with high valuations prevailing in the small cap space. Because in the small cap space, the problem is with the aggregate, right? Aggregate speaking, you may find the indexes at a high valuation. But given the large universe, there are pockets of opportunity. There are pockets which are growing fast. There are pockets where evaluations are reasonable, which we can buy and construct a meaningful portfolio of 30, 40, 50 stocks.
Thanks, Chirag. Chirag, there's a question that in line with that, like, are you buying research or doing your own for such a vast universe of a stock?
So I knew that this would come. So I have put that screen right now. So if you see, given this large universe, we need to keep our eyes and ears open completely to many of things that we may miss. So overall, we do have a large support from sell side. We do have large support from independent research agencies, and whatever comes from there, it's not that we buy what they say, because there is always a vested interest, a conflict of interest into what they are pushing. So we will keep open from an idea generation point of view, looking at those ideas, but we will do our own deep dive when it comes to looking at those stocks. So our analysts at Quantum will kind of do a deep dive, build a 5-year projection of those companies, meet managements, prepare a detailed model, and see whether it makes sense from a buying perspective or not. Again, we will, as we have an integrity screen to look at governance aspects of those companies, we will run that company through that integrity screen as well. So overall, there is a deep dive at Quantum that happens for any stock that will eventually make to the portfolio, but we are open to ideas. They may come from anywhere. And given the large universe, we have to be open to such things.
So next question is like likelihood of Quantum small cap fund making its way to your multi-asset fund?
See, in a multi-asset fund, right? What is the crux that we are trying to do? What is the fulcrum of things in a multi-asset fund is to take that asset allocation call. So we decide what will be equity, what will be debt, what will be gold, and we try to look at getting that equity exposure. So multi-asset fund on its own, given where it stands today, can be scaled up to a significantly high level, right? So given that a small cap fund may have a constraint in form of scaling up. So if you get more amount of flows, we may not be able to replicate that much through that small cap allocation. So it will be like, to some extent, we can buy the small cap, but beyond that, we will not be able to buy the small cap. Say a small cap reaches its size, probably we will close that fund, and therefore any new multi-asset allocation, we will not be able to make in that fund. So we want to avoid that to some extent, and therefore probably we will not make it part, or if we even make it a part of our allocation in the multi-asset, we will keep it a relatively smaller allocation so that we don't change characteristics, what is now and what is in the future.
Chirag, this is specifically for you. If you keep selling every stocks completely, which hits your 5% upside, do correct me if I heard incorrectly, and you don't find another opportunity, then the money would keep lying in cash. How would this work?
So as I said, the universe is pretty large, and it is upon us to identify that next big idea. So I think it is a too extreme kind of scenario where from 900 stock, I am not able to replace 1 to 5 stocks that I'm selling. So probably temporarily it may happen that, until we are very convinced of that stock, or we will be waiting for the valuations to become better, there could be some slight inching up of cash if we are not able to find that next big idea. But probably, given that we will be covering many stocks, it may very well be that we will find that replacement idea. So I think it is one of the extreme scenarios that we are taking here, where there is a dearth of idea. And in that case, if there is no upside on potentially coverage that we have, then probably that may result into some cash holding. But otherwise, we should be able to, if we have good eye for opportunities, we will be able to identify that next big idea and fill it from the sale proceeds that we get from selling the stock.
Next question is like, I'm in the process of switching from SBI small cap to good small cap, where the AUM is less than 16,000 crores. As you know, returns are reducing when AUM under this fund is very fatty. Your view, please.
Yes, see, you need to see that, because there is a capacity to any mandate, which is defined by the liquidity and market cap of those companies. For example, if a car manufacturing guy has, say, a manufacturing capability to make, say, 100,000 cars a year. So when you buy the car, you don't call or ask the seller that, is what number car this is. Is it the first car? Is it the 500th car? Is it 5,000 car? Or is it 90,000 car, right? Until they don't exceed the 1 lakh units that they can manufacture, you are indifferent to what car they sell to you, right? Similarly, in a fund, when you are investing, the first rupee, the 500 rupee, the 1,000 crore rupee, or whatever the scale that the fund can do, that should be invested in the same way without changing the characteristics. If they are changing the characteristics, then probably, whatever track record they have generated is no longer true because the characteristics are completely changed. So what you bought in, assuming certain track record, may not be repeatable or may not repeat because the characteristics have changed. So what you bought as an apple is probably now a banana. So you need to take cognizance of the fact that changes could hamper your risk return profile that you have seen in the past. So overall, ask your fund managers. I have been managing the quantum equity fund of funds. And, when I ask the fund managers that I meet, what is the capacity of your fund? I get very vague answers to that question. What are you talking about? There is nothing like capacity of a fund. If that guy can manage 50,000 crores, I can also scale up to that size. There's no challenge for me. So many of them have not thought through in terms of what their liquidity and their characteristics support as the capacity of the fund. Whereas we do have at any point in time, but also take into consideration the liquidity and market caps as they increase the capacity of the funds. But on any given day, there is a set capacity to which the fund can operate. And therefore, if you think that your fund cannot support that 16,000 crore or whatever size that they have become, then probably you should exit, because otherwise you're taking unnecessary additional risk being in that fund. Small cap is a risky proposition overall, but with not looking at those risks, you're adding to the risk profile of your investments. So don't do that. If you think your fund does not cater to that, consider the quantum small cap, because we will adhere to the liquidity market cap thresholds that we have defined, and at the capacity, we will close the fund.
Thanks, Chirag. So, Chirag, next question is basically, could you please explain the pros and cons involved in factor investing? Example, value factor, price factor, momentum factor, quality factor, etc.
Yeah, so in a factor investing, you are relying on just one trait of the factor, whereas there are many things. Even for a value factor, you need growth. So growth and value factors are very, very different. But even in a value investing, so when would you realize that value? There should be catalysts, and usually the growth is that catalyst for the company to reach the valuation that it should command. So overall, splitting these into different forms of factors may not be really helping you as an investor. Though, and these kind of things usually happen when you are trying to make a core and satellite portfolio. So if your core portfolio has certain traits, then probably you may add it up by adding a factor value. So for example, if you are a core really value investor and all your funds that you invest into is value, then probably through a factor investing in time kind of quality and growth, probably you can add and diversify your overall exposure. So that is where you look at that. But all fund managers probably will be looking at all things combined, because value investing cannot work in isolation. They also want earnings growth in companies, and which can only happen if the revenue growth happens. So it is all combined that the fund manager sees, though they call it themselves a growth manager where they prioritize growth, but they might also be looking at some valuation metric. Value investing also looking at valuation as a core criteria, but they might also be looking at levers of earnings growth in those companies. So overall, from that perspective, I think investors should identify good funds rather than get into factor investing. The factor investing kind of things are built on models, and models can work only in certain kind of scenarios. And usually we have seen that models work till they work, and thereafter you are disappointed with the performance. So I think identify better funds to get into rather than going into the things like factor investing.
There's a question on long-term equity value fund. When you analyze the performance of the fund, do you look at it? Do you look at the benchmark or versus other funds in the category as well? Since value is subjective, some funds may say they are value but be positioned on the growth style, and hence during some frothy markets, your fund may see relative underperformance.
So I think as an investor, what I'll guide you is that look at whether the fund is giving you reasonable returns, sensible returns or not, and while adjusting for the risk that they take. So many funds may take overt risk, and therefore you should expect a higher return from them, right? So when it comes to the value fund, we don't have a value benchmark as such, not really, which is a history of being real true value. So in a value fund, there is a industry specific benchmark that we were forced to take, which is BSE 500. So I don't think that BSE 500 is a value benchmark, but we have been forced to take that, which was decided as an industry as a whole, that for value fund, BSE 500 will work as a benchmark. Again, an instance that I'll give you, like it was rightly pointed in the question, that many would tell that they are value, but they are not, may not be strictly value. Value as a style is in the eye, value as a trait is in the eye of the beholder, right? How you define value versus what I define value may be very, very different. And our definition of value is very much out in the open. We buy stocks which trade at a discount of anywhere between 25 to 40% to its intrinsic value. So any point in time, we can tell you what the intrinsic value of that stock is and whether it is trading at a 25 to 40% discount when we buy those stocks. So I don't think anyone has defined their value trade so clearly that like what we have done. Also, if you see the long-term equity value fund and the tax saving fund has similar portfolio and therefore similar risk return profile. Whereas if you compare the value fund within its value fund category, it may not show so good because many of the funds are more, mid capish, or, they may not emphasize value as much as we do. Whereas if you were to look at the tax saving fund within its category, it is ranking much better as compared to value in its own category. So, same portfolio, different comparison sets yields you different results in terms of rankings. Rankings we think are transitory in nature, and therefore you should see whether you are getting the sensible return for the risk that you are taking in that fund or Indian investment is what you should look as an investor.
Thanks, Chirag. Abhilasha, next question to you. Are you supposed to deploy the funds received through NFO in next 2 months fully?
So as per SEBI regulations, we will have, after the allocation, we will have around 60 days time to deploy the funds. So basically it is like SEBI has defined it as a 30 days, and then we will take internal IC committee approval to deploy it over a period of 60 days. So that is like over. So this is for the, so there was, I think, one question also, will we be 100% investing into small cap? So I'll just address through this also, that as per SEBI regulation, we are supposed to invest, I mean, we are required to invest only 65% of the entire allocation into small cap. 35% we can have either, any other asset, large, mid, or cash or whatever. But so over two months, we will deploy 65% in small caps, and we, depending on the market situation, how the fund, how do we see other opportunities, we will deploy the entire money over a period of time. Chirag, you want to add anything into this?
No, that's very correct. That we have 60 days time to build at least a 65% exposure to small caps. Rest depending on the market scenario, etc. We could be, judiciously taking call of, building entire small cap portfolio, keep some in large and mid, or have some cash. So we will judiciously use our judgment to build that portion. But at the end of 2 months, we should be 65% into small caps.
Thanks. Chirag, next question to you. Why inflow has increased in small cap fund nowadays, specifically after COVID?
So one is the returns generated by the small cap space, right? The returns have been pretty good, and we see a lot of investors look at returns and invest. So we have seen that return chasing behavior as well, where many are investing because they saw better risk returns or better returns in those funds. A is that, and second is that realization that the universe of the other two large cap and mid caps have got constricted, and therefore many are choosing to get into a larger opportunity set, and therefore 3 things that fit the bill is either go for flexi cap, multi cap, or a small cap. And many of the even flexi cap funds have become very large in size, and therefore the ability to have a dedicated small cap or large small cap exposure is also going down from that perspective. So a small cap fund can really get to recognize the opportunity that exists in that space on a standalone basis. So I think that is why we are seeing much interest. But I think with the inflows, we have also seen the changes in portfolios of many of the schemes, which shouldn't have happened ideally.
Yeah. So this question, will you be investing in this fund under NFO or after launch? Skin in the game. If yes, how much as it will give us confidence?
Okay, I will personally invest in the NFO. So I will be investing amount in NFO. And from a skin in the game perspective on an ongoing basis, 20% of the salary of CIOs, fund managers, research teams goes into the funds that they work for in the proportion of the AUM. So there is a lot of skin in the game happening. 20% of gross salary, not even net salary, gross salary goes into, after that mandatory PF deductions, which are very, very small, goes into the funds that we oversee. So there is a lot of skin in the game, but personally, I will also invest in the NFO as well.
What will be the allocation of large and mid cap stocks in this particular fund? Apart
So
from
we
the small
will,
cap, yeah.
so we will want to build a more small cap exposure. But there could be opportunities. There could be some liquidity requirements. There could be some space that we may keep for large and mid from time to time. It's not that always that will stay. If we find meaningful opportunities in the small cap, and then we could be more into small cap, and that large and mid will be a smaller portion, just to be opportunistic, or just to be having some additional liquidity into our holdings. So you could say that a large chunk of our portfolio will, over a period of time, be built into good small cap companies. And as there was a previous question, right, that if you don't find ideas, then probably 65% has to be small caps. But if there are ideas not in small caps, but in mid and large cap, then probably we may take on an opportunistic basis there as well.
In the Economic Times newspaper stating that 90% of mutual fund does not beat their benchmark. Is it true? What is mentioned in the leading newspaper? Please confirm.
So 90% was, I think, some time back. So what has happened, so last year when there is a SPIVA scorecard, which comes from S&P, they published a report saying that, looking at the fund's performances, how many have beaten the benchmark. So last year when they came up with the SPIVA scorecard, as it's called, 90% of the fund managers were underperforming. And that was for a reason. I think the time period from 2017 till 2020 was a much polarized performance. There were few stocks leading to the performance of the benchmark, of the indexes, and broader market was struggling. But if you see now, over last 1-2 years, we have seen a broad market rally. It's no longer being driven by just one or few stocks in the index. It has been a broad market participation. And whenever you have that polarization performance, which was earlier, you might find it difficult as an active fund manager to beat the benchmark. When there is a broad participation, many stocks, many sectors participating to the performance of the indexes, then you see the active fund managers outperforming the index. So the 90% was a last year number. The number has come down to about 50-60%. And if we expect the broader economy to do well, and overall there is a broad participation from different companies, different sectors, then you will see incrementally more active fund managers outperforming the index. So that 90% has come down now to about maybe 60% or so. I don't remember the actual number, but my guess is it's closer to 60% that I last saw.
I think so. This could be the last question, Chirag. What is the targeted returns in the small cap after 5 years?
So, there is a math towards it, right? Say India is growing. I do have a slide on that. I can just pull it up very, very quickly. So if India is growing at 6.5% real GDP growth rate, which we expect it to grow over next 10, 20 years, and historically, India has grown at 6.2% real GDP growth rate over last 40 years. So we don't see that changing. India will continue to grow at 6.5% real GDP growth rate for next 10, 20 years. And if that's the case, there will be inflation of closer to 5%. And if you add the two, India on a nominal basis will grow at about 11.5, 12%. So if India continues to grow at 11.5, 12%, then that's the average growth rate in the economy. I may not have it here. Here it is. So India on a nominal basis, if growing at 11.5%, then revenues of companies, because GDP is nothing but sales growth in some sense. So if sales or revenues are growing at 11.5%, typical large companies that are part of indexes, listed companies, etc., will be growing more than the index. So we have seen generally it's around 2%. So 11.5 plus 2% is 13.5%. And if you think that, good companies, listed companies are growing at 13.5%, and if you as a fund manager can identify companies which are growing even faster and, time it well, then probably those revenues will be growing. We take an assumption of 1.5% additional at 15%. So if revenues are growing at 15%, profit generally grows higher than revenues because there is an operating leverage that kicks in at some point in time. And therefore, they should be growing higher. But even if you assume that profit growth is equal to revenue growth, it will be growing at 15% overall. And so if 15% is the profit growth, earnings growth, then probably market reflects fundamentals, market reflects earnings growth. So the stock prices should grow at 15%. If the stock price is growing at 15%, that is generally for the large companies. The smaller companies grow faster than the larger companies, and therefore they should deliver a higher earnings growth, and therefore they should deliver a better return profile than what the large company gives. So the large company is giving 15%, you may add maybe 2, 3, 4% to what a small company can deliver. So I think over the long run, this should ideally pan out the way it is. And that is the kind of returns that investors can expect from Indian markets, from small cap companies.
Thank you, Chirag and Abhilasha. With this, we will end our Q&A session. Chirag, any closing comments from your side?
This closing comments is that small cap is a great opportunity. It is a very large universe, and large universe means large investment opportunities. And given that there are risks in many funds that we see in the industry, there was an Economic Times article a couple of days back, which highlighted this problem that we also spoke about. So overall, if you think you are invested in small cap space, and if you see that there are additional risks to your investment where you are invested in the funds that you are invested, then probably it's time to make that switch from those risky propositions to a small cap fund like the Quantum Small Cap Fund, which will adhere and not add to your risk, but control and manage those risks and give you a sensible rate of return for your investments. So overall, I think this is a great opportunity. There's still legs to the rally that we see, because we think that economic growth will be there for next couple of years at least, if not more. Then you need to stay invested. We are somewhere in the mid-cycle when it comes to the economic recovery that we are seeing, and still a couple of years or 2-3 years more to go. Given levers are very, very real, like real estate, or be it the capex story, we think there are legs to the recovery that we are seeing, and therefore small cap gives you that opportunity to ride that India story very, very well and invest into the budding sectors that are not present in the large caps. So I think either if you are not happy or you see risk in your investments in other small cap funds, or if you are not allocated to the small cap space, please invest in the Quantum Small Cap Fund.
Thank you, Chirag and Abhilasha. Further, for any questions to be answered, you can write to us at customercare@quantumamc.com, and we'll be happy to answer the same. Please do consider Quantum Small Cap Fund in your portfolio. Once again, thank you everyone for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.